Welcome to another exciting episode of The Trading Bell. This week on the show, we shall be dissecting into what to expect in 2021. We'll be speaking to a set of panelists who will be navigating for us what will be big in 2021 and what to look out for through the year. Let's take you now to that discussion. Allow them to introduce themselves. Let me go with the ladies first.
I'm Emily Keegan, Clearing Operation Analyst at the NSE, and my outlook for the year, with the blessings of the rain in January, the positive outlook.
All right, very subtle. Mr. Gishoi.
My name is Samuel Gishoi. I'm the Head of Business Development at NCBA Investment Bank, Brokerage Division. I think I'm a perennial optimist, and I believe that any downturn, what goes down must come up, just like what goes up must come down. Yeah. So I think this is about time we started to see a recovery here.
Interesting, the law of physics. All right.
My name is Sarah Wanga. I'm the Head of Research at AIB Access Africa, and I'm positive about this year. Last year was negative for the markets, and so I see a recovery in the equity market and fixed income space.
All right.
Yes.
Well, ladies and gentlemen, it seems like everyone has this narrative that 2021 will be a better year. You could clearly see it how Kenyans celebrated the end of the year, say we are ushering in a new year with lots of expectations. It seems like 2021 has a lot to offer. Let me pick your mind, Gishohi, especially considering how the past year was turbulent. We did see companies reporting losses. We did see companies downsizing their staff. And right now, is the same situation going to abound?
Well, I think what we're seeing is the feeling that the worst is over. I mean, hope is what keeps the human race going anyway. Yeah. And that said, COVID-19 was unprecedented in terms of its impact. It was something that we have not faced in this generation. It was something that affected everybody globally. This was on a global scale. And so it means that we are living in a new normal. Everything changed in an instant. I usually say, I think God pressed the reset button. And so we have seen that companies have had to change a lot of the way they do things. Things like working from home, things like remote, meetings, etc. I'm sure even in the press you've had to change a lot of things. Definitely. So I think the companies that are dynamic will survive this. They've already had time to learn, which means that now 2021 will be when they actualize those strategies that they have now set up. And so the expectation is that we are going to see now improvements, maybe some failures which we learn from, etc. But again, we've seen a lot of profit warnings in 2020. The expectation is that now that there has been all those restructurings, as you've said, companies have let some staff go, there's restructuring of the way they do business, then naturally it means those reactions, if they were done right and at the right time, means that those companies should at least improve their bottom line by reducing, say, on costs, staff costs and other overheads. So that is a good thing and a good expectation for 2021. Of course, we don't expect to see a good dividend year, considering last year was not good. So we can't expect them to go back to the normal dividends, given that, of course, we have had also the profit warnings. But at the same time, since prices are very low, chances are, as we see foreigners and local investors starting to come back to the markets, then we could see a rally that will make the dividends irrelevant anyway.
I don't know if, Sarah, you agree with him. You did touch on recovery is near sight. What will lead to this recovery, really?
So we'll probably see an inflow of foreign investors. Last year, there was a net outflow from the securities markets, but this year we're likely to see them coming back into the market, mainly because of the attractive valuations. So companies are currently trading at close to their one-year lows, and then there's expectation that earnings will start increasing in 2021. And as you look at banks, so a number of banks are likely to record a decrease in earnings this year. But even as we looked at how they performed last year, looking at the first 3 quarters of the year, we saw that their core business was still intact. So interest income was growing, non-funded income was also relatively stable. They only had an increase in provisioning. So as an investor who's looking to invest in the equity market, to look at banks, you'd like, yes, this year they'll probably be hit by the provisioning of 2020, but now 2021 earnings are likely to increase because their core business is solid. Safaricom is also performing very well, and also given that there was the reintroduction of charges, so we could see their revenue increase. And so I think that will probably be one of the reasons why we'll see investors slowly come back into the market.
All right.
Yeah.
And Madam Keegan, interesting sentiments from a panelist. I don't know, where do you stand in all this?
I share the same sentiments. I look at, and I take the analogy of a swimmer. You dive into the water, you have to find your balance, then you stabilize in the waters. Then I'm looking at the market. There was a dip towards the end of August. We see some stability, even in terms of prices. Prices still coming up on the different stocks. So I think we are at that point of stabilizing and now adjusting to the new normal.
All right. And still staying with you,
Yes.
You're saying we are in the process of stabilizing, just using that narrative of the swimmer. The tides in the water can also resurface again. Do we foresee a situation where the restabilization can be thrown back to the back burner?
I usually look at the biggest hit as the one that we were caught unexpected last year with the COVID coming in. No one expected it. Now that we are aware this wave is there, we are better prepared for such a wave. If it comes, the muscle is there, at least built from that first shock.
All right, I can see Gishohi smiling and itching to respond. But before you respond, Gishohi, we have a very interesting clip we want to play right now, where the CEO of the NSE, Mr. Geoffrey Odundo, did also share his sentiments and expectations for 2021. Let's listen to that and then we progress.
As you rightly put, there are a lot of moving parts in the economy. On one hand, government has to continue with their programs of infrastructure development, of providing social amenities to Kenyans. On the other part, we have got the issue of the upcoming elections and some of the political issues that are taking place. But one thing I'm happy about, especially the political side of Kenya, I always say we've got a very strong political infrastructure. And you can see it at work. We have systems at work. The legislature, the executive, there are ways of accountability. People speak their minds, and that kind of thing. And that's very important to investors. Investors want to come to a market where they are sure that political stability is in place. They don't have fears that there could be changing policies that surprise them. And I think that that's happened very well. So all these issues that we are ventilating as Kenyans, I think is only good for us. Even how to improve the constitution. I think the ventilation is very, very important.
Okay.
And that's a good sign. It's a good vital sign for economic growth. So I think with that's going on one part. I'm not an expert in that, so I cannot comment further than that.
All right.
But I do speak to a lot of investors, especially international investors, and they're very happy about Kenya's macros. They're happy about how we are managing our key areas. First of all, we are a very diversified economy.
All right, ladies and gentlemen, that is the CEO, NSE, Geoffrey Odundo, just giving his remarks as we kick off the year. And from you, Madam Mwanga, of course, very solid sentiments there when he talks about the political noise. We are going into a pre-election season where we are having a constitutional amendment moment. And it is known very well that anytime there is political activity and it overshadows economic development, we are likely to see the numbers dipping. How will this work out this year, especially now that we are seeing a lot of interest by investors, like you did say, in terms of the Kenyan market and East Africa at large?
So I think the way investors look at our political environment is not the same way most of us Kenyans look at it. And like just if we were to go back to 2013, which was a key year in Kenya, local investors were a bit afraid of investing in the equity market, yet we saw an increase in foreign investor inflows, and that drove the rally for a number of years.
So
and
the markets are quite resilient?
Yes, they're
That's
quite resilient, yes. And foreigners might not necessarily view this as being a reason for concern. Yes, as in 2013 it wasn't a reason for concern, and so they'd look at the fundamentals. So what is happening in terms of the economy? As was mentioned, that we are a resilient economy, we are a diversified economy, and so if growth is likely to come in regardless of the political environment, and people are confident that there'll be political stability, yes, there might be some noise here and there, but the overall economy will grow, then foreigners are likely to come in to the market.
Madam Keegan, what are your thoughts on this?
My thoughts on the policies and even the structures put in place currently support a stabilized economy, because I look at even the rates, interest rates, in terms of towards the end of 2015, when we had our previous election, we had rates of around 15, but structures put in place right now are maintaining the rates at affordable rates, whereby even when it comes to lending, the banks are guided on what rates to lend at. So we are not seeing rates in terms of government bonds going extremely high, or even the borrowing being very expensive for the institutions.
All right. Kishoi, finally to you.
Right. Actually, I agree with Wanga. Interestingly, if you do a technical analysis of the NSE 20 index for the last 4-5 elections, the market has rallied in the year 2 elections. All the dips have come after elections, not before. And interestingly, we see a lot of inflows during the year 2 elections. And I think there's a bit of contrarian behavior there on the part of the foreigner. They know locals are not buying in the market because they're saying, let us wait for the election. Yeah. So they buy during that year and then they sell to us at a high price after the elections. If you look at when we had the post-election violence, the market didn't necessarily dip because of the post-election violence. What really hit the market was the credit crunch crisis, which happened, which was external, which again points to foreign outflows. When foreign outflows happen, it happened with COVID, the market will slump. Then the valuations will become so attractive, the foreigners will come back. Foreigners coming back, of course, has a lot to do with what is happening again on the ground. They are suffering a lot from COVID than we are. The fact that we are doing much better is probably going to make them feel that this is also a more attractive destination because we don't have lockdowns. Our businesses have not necessarily stalled completely. If you look at horticulture, last year we exported more because the people who usually go to do the planting in, say, the UK from Eastern Europe did not go because they can't move. And so our agriculture sort of thrived. The retail investors, in fact, you'd be very surprised to see, have supported the market during this time. Actually, it was not expected because we thought the foreign outflows would really, but we have seen the support from the local investors. The expectation is as foreigners come back, they're going to push the prices up. And so I do agree that we are a resilient economy. We've had elections. I think the worst happened during the post-election violence. The fact that we are talking about it, and I think Jeff alluded to it, that noise is good because people are venting. See, before we were not talking about it. So when the elections happened, we started fighting. Now, even before we get into that election season, it's already on the table that we cannot afford to have such fights, and this is what we want to do, whether we oppose it or we agree with it. It just shows a stronger democratic space.
Interesting insights. And back to you, Madam Wanga. So for the investors out there, they are asking a simple question. Are we likely to see kind of a fast-paced rebound of the markets now that the year has begun on a stronger note compared to how we closed last year? What do you see when you look at the numbers?
So we'll see a gradual recovery. So in the first quarter, banks will be, actually most companies will be releasing their 2020 numbers, which will not be that good, but a number of that has already been factored into the expectations. So we'll see prices slowly continue to increase, and then towards the second quarter, now as foreigners continue to invest in the equity market, we'll see the prices rally. So it will be a gradual increase in prices.
All right. And Ms. Keegan, looking at what Madam Wanga just brought up, of course, what will be some of the key drivers, especially now that we're looking at our debt situation as a country? We are literally trying to get more debt relief to be able to take in a bit more of a reprieve. Economically speaking, what sectors are we likely to see that might be the major economic levers that will usher us into a better place come 2021? Exactly the same analogy, that swimmer who was swimming, a small tide came in. What will that be that will catapult us to getting to the finish line?
First, I look at the tech companies in terms of right now with the virtual, even education sector, embracing the virtual learning and all that. I think the tech companies will be a leverage to us. Looking at the agricultural sector, the weathers have been favorable. I might say God has really looked. He doesn't hit both sides at the same time. At least there's room for like a breather. So agricultural sector will hold us up, and the banking sector, I think with the embracing of technologies, I think it's a rebound for them as well.
And Gishoy, I saw you nodding profusely.
No, I just thought COVID seems to have taken care of the locusts.
But they're still around.
Yeah, I know they're still around somewhere, but yeah, but I think they're not coming where there's too much COVID. Anyway, that said, I do agree, but I think what investors need to be very keen on right now is the volatility. Volatility is your friend, and what you need to do now is, I know the most active counters will have the big, the big three: Safaricom, KCB, Equity. Then we have the other banks there, and of course we have the EABLs and the lot. But we are going to see quite a bit of volatility because recovery does not happen in a straight line. So that's the volatility you need to ride on. Buy high, buy low, sell high. Buy low, sell high. So we have seen, even if you look at last year, we saw the likes of KCB go to what, 34, go back to 40, and then come back again to 35, 34, 35, and then go back to 38, 39. Now that means that anybody who was riding that wave made good money in 2019, in 2020. And so 2021, because the recovery is going to happen, so, and as the foreigners come back, it doesn't mean they come and it goes in a straight line. It's not going to be sudden. There's going to be a lot of volatility, and that is the investor's best friend. I think before COVID, we had reached a point where some of the stocks, and I think Wanga will agree, were at very high valuations. And so we were actually looking at stagnations because the volatility sort of goes. They're not going down, they're not going up because they're sort of at a value where people, the buyers are not willing, the sellers are feeling it could go higher, etc. But right now, because there's that consistent expectation, then investors can make good money this year.
And Madam Keegan, you brought up a very important issue that ICT will play a critical role in 2021, especially now that we are seeing quite a lot of transitioning where there's e-learning happening in schools, universities. Corporates have also embraced technology in a big way. And in line with taxation, we know the taxman, KRA, also introduced the digital service tax. And this is basically to target the netizens, the people making money like Gishoy, who's selling avocados and marketing them online. Of course, on a light note, but really, what is the scope for the taxman in terms of actualizing this, and how much can they really net from this particular technology front?
As they say, a journey of 1,000 miles starts with a step. So I think, yes, they may not get much in the first place, but I think gradually, even I look at these other taxes, they've gradually come into play that more people are compliant in terms of paying their taxes and even being accountable in that arena. So I think with this introduction, I think with the persistence in terms of reminding and educating why it's important, because at the end of it all, when we all learn the importance of paying our taxes and proper accountability, no one will have a problem paying their taxes.
Right. And still with you, Madam Kigen, when we move this conversation forward, as we look to bolster tax collection, some say we haven't exhausted other avenues. We have people who are sitting pretty, and yet they are very potential targets for tax, and these are presumptively the rich, who ideally conversation on the ground is they need to be taxed more. I don't know, what's your feeling about this?
Is it being taxed more on the rich? Because I feel the current tax brackets, they are gradual. They are not hitting the person earning less than 24,000 with a huge tax compared to the other. So they are gradual. So I can say there's quite a spread that covers almost everyone when it comes to, let's say, payee. So when you look at the other taxes in terms of businesses and all that, I think it requires better planning, which I want to believe the government is putting measures in place, because you can't just, I look at the introduction with the ETR, at least it came in, made the small businesses be accountable. Yeah. So I think measures have to be put in place, first of all, to ensure the tax, as much as it's being introduced, it is serviced.
All right. And Gisho, you'd like to weigh in on the tax?
Taxes have a tendency to make us less competitive, especially in a country where we rely on SMEs and small, individual-owned businesses. And I think building the base, you need to make somebody taxable so that you can tax them. So I think at the bottom, increasing that bracket to people who are earning less is going against what can really help us to reach that point where, because I want somebody to go from earning 24,000 to earning maybe 100,000 and then tax them. Rather, because then I encourage that growth. The more licenses we have, the more businesses are unable to, they're paying more, which means their products will be more expensive, and that makes them less competitive. And if we are going to grow our export base, if we want production to happen, then I think we need to be very, very careful and clear about how we are going to go about this taxation. Because I remember there's somebody who said, look, we're building the SGR, we are a net importer. What we should really be fighting about is not how expensive the SGR was, is what are we going to take back on that train? Because if the train is bringing goods from Mombasa, what are we taking back? And so it needs a very targeted process to make sure that there's enough production that is now filling that train back to export, because that's the only way we are going to be able to generate enough to pay our debt. Taxing, if it doesn't improve our productivity, is just going to be detrimental in the long run.
Interesting, and it speaks to Madam Wanga's analogy of the twin deficits. And as we wrap it up, ladies and gentlemen, I just want to also urge you to talk to our investors. 2020 was a year where we did see a spike in the number of Kenyans who registered their own businesses. Looking at the data from the Registrar of Companies, we are looking at a 58% rise in companies that were registered between April and November, which hit about 65,000 new companies registered. And speaking as analysts, what are some of the lessons you'd like to share? And what are some of the expectations you have when it comes to Kenyans being entrepreneurial and investing in the right stocks, investing in the right economic activities that can see them make some good income at the end of the day?
I think it's important for you invest to carry out necessary research. So make sure that the venture that you're investing in, you understand it. So unfortunately, most of us Kenyans sometimes just copy what our neighbor is doing. Like, we've seen a lot of that. Like, someone opens a petrol station next to you, then you find another one very close to it. And so it's about knowing the market and making sure that you have the right venture. And in terms of the stock market, learn more about the companies, learn more about the investing universe, and talk to your brokers and have an idea of what is happening generally, and then you can have a better view of how to invest in a particular stock here.
Excellent. And of course, the Trading Bell is the home where we inform our viewers. And
yes.
Mr. Kishore, your closing thoughts on the same?
We have, to me, that's a good side of COVID. It might have, disrupted, and it opened our eyes. And businesses were registered. Why? Because a lot of us got out of our comfort zones, which I feel is a good thing, because it will drive the next wave of entrepreneurship in the country. Because now people have sort of come alive to the fact that employment is not forever. There's something you've been putting away for a very long time, and then the shock came and you had to do it immediately. I agree with Wanga. You need to do your research, know the market, understand. Because a lot of us Kenyans, we go and do things and then you learn the hard way. But if you haven't done that, learn from your mistakes. The other problem I've seen with Kenyans in investment is they give up too soon.
They want to kuomoka.
Get in, next month you're already you've broken even and you're making profit. It doesn't work like that. Investment, wherever it is, and that's why we are very gullible to all these pyramid schemes and stuff. Because we want to be told we are making 50%, 20%. But any honest business is not going to be like that. There's the 1-2 businesses that do it, and we read about them, the Googles but honestly, business or entrepreneurship is a long journey. The 1,000 steps, you have to take them step by step, be patient, learn from your mistakes, and learn about what you're investing in. As you said, Trading Bell is one of the places where you can come and just listen and, new terms and what happens in markets. Understand what you're investing in.
All right. You have the final say.
Thank you. For me, it'll be take a balanced approach. As we are told, take a balanced diet, take a balanced investment. Risky investment, more secure investment. The market offers you, as an investor, more secure, more liquid assets, so you can balance your portfolio such that if the business you've put in your money in, a percentage, if it goes bad, at least you have something that will pay your bills and take care of your daily expenditure.
Wow. Quite some interesting sentiments coming out of our analysts, just dissecting what to expect in 2021. Well, just before we wrap up the show, let's take a look at how the money markets have been performing. Quite an insightful session we've had with our analysts, just giving us the lowdown on what to expect in 2021, and we do appreciate your insights. And remember, you can engage with us on our social media handles appearing at the bottom end of the screen, and you can also keep us posted by sharing with us your thoughts, your questions, and we'll be able to tackle them in our next edition. From me and the entire team, it is bye-bye for now. Take care, keep safe.